kick off with a look at the shilling and everything that's been taking place to try and stem its free fall. It has firmed up since Tuesday's low of 107 against the greenback. Just your take on what's driving the shilling what drove the shilling to the record low and what's helped it firm up at this point in time.
Thank you for having me on the show. On the shilling, it's been a very interesting week following last week's decision by the MPC to hike up rates. As a house, we actually thought this would be a huge positive for the shilling, and we actually expected it to go in the reverse direction to levels lower than 100. But then what happened post this announcement is it went up to almost 107, and the local market was actually anticipating 110. So it's been very interesting. I mean, you're looking at it from an academic point of view, and you expect the tightening monetary policy to actually have a strengthening impact on the currency. Yet there's been a bit of short selling in the market, which has worked against this. But I think what's going on with the increased demand for the shilling, with the local importers, with the local banks, that's actually probably going to help stabilize the shilling at maybe the current level 100 to 105, at least as the week ends, as opposed to 110, which is what some of the local dealers expected.
Some are saying that the shilling at this level could trigger dollar demand. The technical chart is saying that the shilling has to firm below 103.90 to have a substantial recovery in the shilling against the greenback, of course. What do you see? At what point in time do you see a meaningful recovery in the shilling?
I think at this point, trying to make a firm position or try to take a firm stand on the currency, it's not really, it's actually going to be in vain and counterproductive, because as I'm saying, on one end, you're looking at it academically and expecting it to actually strengthen, but then there are also the trading dynamics that are actually playing in the market. And it's now at 105 as of yesterday's CBK rates. The day before it was 103. There's been a bit of strengthening, but I think it's sort of straddling between 105 and 103, and it could probably close the week at 105, 103 range. That is at tomorrow's close. And
of course, Kenya, not an island. We've seen how the rand has been hit, the naira has been hit, the Ugandan shilling have all been hit by the Eurozone debt crisis and, of course, global jitters. So to what extent would you say the shilling's free fall has been accounted for by the Eurozone concerns?
Maybe I'll answer that differently. Probably what I'll say is Nigeria actually also did something similar like what the MPC did last week. They cut back on, they increased their central bank rate. But what the difference was is they also increased the cash reserve margin that the banks were holding from 4% to 8%. So of course this has definitely had a positive impact on the naira and strengthened it over the last couple of days. I think in terms of looking at the Eurozone and its impact, there's been a flight to quality. There's been a risk aversion sentiment going through the market, with most of the investors actually preferring to hold dollars and holding back on their investment decisions, at least on the Nairobi Stock Exchange and on any other private equity kind of investments that they're doing, just to wait and see where the KES to the dollar settles off.
Let's just take a step back now, because we've had the NSE 20 gaining for the past 3 days, but overall the market is severely depressed for 2011. From your standpoint, is there still a compelling reason to put your money into Kenya equities at this point in time?
At this point in time, the macro environment for Kenya is not particularly attractive. I think the only upside that you can see is hopefully if the October-December rains actually come forth, and not only Nairobi, but across the country, then that could actually have a positive impact on food inflation. But at this point in time, the Nairobi Stock Exchange is doing a cumulative PE of 8.5 times. That by any standards is very low. But what tends to be the key risk is first the currency, the widening current account deficit, and as well as the rising inflation, which probably means that next year earnings that most of these companies will deliver won't be able to compare to this year. Case in point, if you look at the banks, you've already mentioned earlier that most of the smaller banks have already passed on the CBR rate hike to the customers. We'll definitely see a slowdown in credit growth and a slowdown in also net interest margins, which definitely has a negative impact on the year-on-year growth on profitability. So you have a dire macro, which will actually have a 6-month to 12-month lag effect on the micros of the companies listed on the Nairobi Stock Exchange. But on the converse, some of these companies like EABL that can actually push on the prices of push up the cost increase of their goods to the consumer. For example, if electricity goes up, they can be able to increase the price of their beer products, then that becomes sort of a defensive stock that you want to look out. KPLC also becomes another standard defensive stock that you want to look at, and I think we've been seeing an increased foreign demand for these two particular stocks.
You mentioned EABL, that stock rallying up yesterday, firming up as foreigners come in and buy the counter. Now Diageo has just won that bid to buy that Ethiopian brewery Mbithe Muema. That's competing against the likes of Heineken and SAB Miller. But just looking at the overall East African picture when it comes to the brewery sector really heating up, you've got Bralirwa in Rwanda, which is owned by Heineken, now trying to increase its capacity to counter, the competition that's going on. How firm is East African breweries' foothold in the region at this point in time?
I think generally EABL's footing, at least in Kenya, it's very strong. Where it's probably going to have a bit of a challenge is in Tanzania as opposed to Rwanda, because in Tanzania it will be fighting SAB Miller, and also given the fact that it's about to complete its share swap, selling off its Tanzania Breweries limited stake to the market. So I think Tanzania actually is more of a competitive threat in terms of market positioning as opposed to Rwanda. For Bralirwa, of course, they're increasing their capacity, but this is also in a market that's growing on a year-on-year basis, coming from a very low alcohol consumption level. So there's a bit of room for EABL in that market, especially for the high-end consumer. I think maybe the key thing to look out for EABL is how it's actually going to end up financing its buyback of its Kenya brewery stake from SAB Miller. I think there have been many rumors in the market that a probable rights issue would actually occur. But as a house, we don't think that any capital raise is actually necessary, because they have sufficient funds in their books, and they're actually going to end up paying 19.5 billion for Kenya breweries and end up having to pay about 7 to 8 billion for Tanzania breweries.
Will this eat into dividends going forward?
Sorry? Yes, I think the dividend is actually what will be cut back by about 28% from the prior year levels. So there'll definitely be a cutback on the dividend payout for this year and for next year to be able to facilitate this acquisition.
Just very quickly, COMESA has extended the 2-year sugar import safeguards for local Kenyan sugar producers. Good news for the likes of Mumias.
Good news for the like of Mumias, but I think in Kenya the sugar industry is a very sensitive industry. We've been seeing shortfall in terms of insufficient demand of the commodity, and in as much as the COMESA agreement has actually been extended, I think we'll still see a bit of more imports, because the local market, the likes of Mumias and the other millers, are not able to produce sufficient sugar to sustain the growing economy. So it's a positive for Mumias. It defends its position in terms of local market uptake, but it also opens up opportunities for other people to import a bit more to actually meet the supply deficit.